Good morning, friends. This is Kaustup Pavaskar from the Fundamental Desk. Today we have released a new idea, that is Speciality Restaurant Limited. The company is a reputed player in the fine dining space, which is around 7% of the overall restaurant industry in India. The restaurant industry in India is around 45,000 crores. Organized is around 20%, unorganized is around 80%. Organized restaurant industry is growing at around 25 to 30%, largely on account of improving demographics, increasing aspirations for the quality food, and increasing demand for the value-added services. Specialty restaurants has some of its key brands such as Mainland China, Sigri, O Kolkata, which is getting good acceptance in the domestic market. Company has around about 80% restaurants in more than 22 cities. Company is planning to add 15 restaurants every year over the next 2 to 3 years, and this will result in strong 31% CAGR top line growth over FY 2012-15. The company's key focus area would be improving the margins. The consolidated operating margins currently stands at close to 20%. Company expect margins to improve around 22 to 23%, largely on account of improvement in its revenue mix. Mainland China, which is one of its key brands, which contributes around 60% of the company's revenues, has margins in the range of 30 to 35%. And once the contribution from Mainland China increases, we might see further improvement in the consolidated margins. Also, company has taken a lot of initiatives such as improvement, upgradation in the technology. Also, company is planning to get into centralized supply management, which will help it to improve its space in its various restaurants in urban cities, and other initiatives which will help it, cost cutting initiatives which will help it to improve the margins. Company has one of its strong balance sheet. This particular model, fine dining model of specialty restaurant, is a asset light model where company does not need to invest on a higher side on its restaurants. Company has all its restaurants on lease basis. Whatever the space they have taken, it's on the lease basis. So they have to just invest behind the assets required in the restaurants, as well as the interiors of the restaurant. So not much of the investment is required behind the restaurant, and whatever investments they are going to do in the coming years would be done through the fundraising through the IPO and the internal accruals. Company has a negative working capital. It is largely a cash based model where there are no much of the debtors days. Also, the company's free cash generation ability is expected to improve in the coming years, mainly because of increase in its revenue and strong improvement in the profitability. So we could see that free cash to equity ratio improving in the coming years. We have initiated coverage on the stock with the target price of 243, which provides a potential upside of 40% from the current level. We have valued the stock at 20 times its FY15 earnings of rupees 12.1. We believe that company is a unique investment play in the current domestic consumption story, and we expect strong top line and bottom line growth over next 2 to 3 years. At the current market price, the stock is trading at around 20 times its FY14 earnings of rupees 8.4, and we believe that it's a better play in the current consumption environment, and we recommend stock with a buy with a target price of 243. Thank you.